This morning, COMEX holds roughly 103 million ounces of silver classified as eligible for delivery, while more than 400 million ounces worth of contracts are approaching maturity. This is not a projection or an estimate. It is publicly disclosed data. At the same time, Vance has proposed the establishment of a price floor for silver, a mechanism designed to prevent prices from entering a phase of unrestricted decline. As a result, the central question is no longer what is the price of silver, but rather this: if there is insufficient metal available for delivery, what exactly is the market transacting in? And who ultimately remains exposed when paper claims are forced to confront physical metal? At this moment, while the majority of market participants remain focused on price charts hovering in the high 70s range, a different process is unfolding at a deeper structural level. There are no green or red candles here, no opening or closing bells, only datasets updated day by day and decisions made quietly. This is the layer that very few observe, yet it is precisely where it is determined whether a market is still functioning within normal parameters. Picture a typical morning on the futures exchange. There is no visible disorder, no panic-driven liquidation. Price screens remain illuminated, contracts continue to clear, liquidity appears intact. Yet, beneath this surface calm lies a detail that gives pause to those who understand the mechanics of the system. Deliverable silver inventories continue to contract, while the volume of contracts coming due remains largely unchanged. There is no single disruptive event. Instead, there is a distinct and familiar sensation. The margin of safety is narrowing. In derivative markets, systemic risk rarely announces itself with a sudden shock. More often, it manifests as a subtle shift in rhythm. When inventories decline without a corresponding reduction in outstanding contracts, the system begins to move out of alignment. Under ordinary conditions, such misalignment is manageable because most contracts never result in physical delivery. But when behavior changes, when multiple participants simultaneously seek to verify access to metal, the underlying assumptions that once held the system together begin to lose validity. This is the critical point. Futures markets were not designed to withstand a synchronized test of physical delivery capacity. They were designed to manage price exposure. When forced to address questions of actual metal availability, the system does not immediately fail, but it is compelled to adapt. And adaptation, in financial systems, always leaves observable traces. The earliest traces do not appear in headlines, but in the behavior of large institutions. When positions that were previously held consistently begin to contract at lower price levels, this is not a sudden expression of optimism. It reflects a shift in the risk calculus. In finance, when upside potential remains open while downside risk is constrained by policy intervention, short positions cease to function as neutral hedges. They become asymmetrical risk exposures. It is precisely within this context that the proposal for a silver price floor emerges. Taken at face value, it may appear to be an attempt to support or elevate prices. But when examined through the lens of supply chain stability, its logic becomes fundamentally different. A price floor does not guarantee profitability. It merely prevents prices from falling to levels that disrupt physical supply. For metals integral to energy infrastructure, advanced technology, and defense systems, this represents an effort to stabilize the system rather than to manipulate the market. When a price floor is introduced, markets do not respond with an immediate upward repricing. The first shift occurs in risk assessment. Strategies that once depended on deep price declines to generate returns begin to lose their appeal. Not because higher prices are assured, but because the expected reward no longer compensates for the risk assumed. In the days that follow, surface-level market conditions may continue to appear calm. Yet beneath that surface, those tracking delivery data and monitoring the rate at which metal exits the system begin to detect a different cadence. This is a rhythm familiar to experienced observers. the rhythm of preparation. Not preparation for a price rally, but preparation for the possibility that the system itself may be tested at its limits. Silver differs from gold in a critical respect. The majority of gold ever mined continues to exist as above-ground reserves. Silver does not. Once silver enters industrial production, it is consumed. It becomes embedded in electrical circuits, solar panels, transmission equipment, and technological systems from which it is not easily recovered at the end of their life cycles. As a result, each ounce of silver delivered is not merely a transaction, but a permanent transfer out of the reserve base. This distinction generates the particular tension characteristic of the current phase. No official shortage has been declared. No crisis has been confirmed. Yet those who depend on silver for manufacturing do not view the market through an investor's lens. They view it as a supply chain. And within supply chains, the most severe risk is not elevated prices, but the absence of material altogether. Financial history offers numerous examples in which confidence in delivery mechanisms was tested. Such episodes do not always culminate in dramatic failures. More often, they conclude with technical adjustments, modified contract terms, or temporary measures. But each time, the same lesson becomes clearer. Once trust erodes, markets cannot immediately revert to their prior state. What makes the present situation noteworthy is not any single data point, but convergence. Policy discussions are increasingly centered on supply stability. Market behavior is beginning to reflect a more cautious stance. Delivery data indicates that physical metal is leaving the system at a pace faster than many participants are accustomed to. None of these elements alone is decisive. Together, however, they form a new context. That context places observers in an uneasy position. If one looks solely at price, conditions still appear ordinary. But when examined structurally, questions emerge. What happens if an increasing number of participants demand physical silver from a system not designed for that outcome? No definitive answer exists. Yet the very fact that this question is now being asked indicates that the market is entering a different phase. The defining characteristic of this channel's approach lies not in predicting outcomes, but in tracking early signals. Markets do not change overnight. They change when foundational assumptions are reset. In the current silver narrative, the primary assumption under strain is the belief that paper claims can always be converted into metal without friction. One does not need to be a trader, nor hold futures contracts to recognize this shift. This is not merely the story of a single market. It is a broader examination of how financial systems respond when drawn closer to physical constraints. At that point, speed, liquidity, and flexibility, the advantages of paper markets, begin to encounter concrete limits. It is here that the tension reaches a level at which observers can no longer remain purely detached. Not in order to act, but to understand. To recognize that at certain moments, understanding how a market functions becomes more important than tracking whether prices rise or fall. To understand that prices may remain stable while the underlying structure is in motion. The silver market is currently experiencing such a moment. Quiet, not chaotic, yet significant enough to give pause to those accustomed to reading systemic signals. And once this moment is recognized, it becomes difficult to return to a framework in which everything is measured solely by short-term price fluctuations. The narrative is still unfolding. Data continues to update daily. Policy decisions remain under discussion. Market behavior continues to adjust incrementally. There is no predetermined conclusion, only a reality that is gradually becoming clearer. This market is being compelled to confront its own structural limits. And that is precisely the point at which the remainder of the story becomes impossible to ignore. This is also why the opening question of the video carries such weight. When a market is forced to confront its physical constraints, price ceases to be the central variable. What is being tested is trust, the belief that paper can always be exchanged for metal. that the system remains sufficiently flexible to satisfy all claims. Throughout monetary history, each time this trust has been tested, gold and silver have been reassessed not merely as commodities, but as mechanisms for preserving purchasing power during periods when political, fiscal, and technological pressures converge upon monetary systems. This is not a new phenomenon. What is new is the context. Advanced technology, energy transition, and even space-related demand are once again pulling precious metals into the center of the long-term narrative. This may only be the beginning. The months ahead will reveal whether the market adjusts through internal mechanisms, policy interventions, or behavioral shifts. No outcome is predetermined, but the temporal framework is becoming increasingly defined. How do you think this will influence the way silver is priced in the high-technology era? Share your perspective. This is Money Cycles, where we examine foundational movements beneath the surface. If you want to follow what comes next, you know where to find us.